I had a conversation a little bit earlier, Ben, with one of my guests, and he said, look, the most important thing is that Powell can't afford to sound overly optimistic on the right, but he can't sound gun-shy on the left in terms of preparedness to act. It's a very fine balancing act this week.
It is, but I think one of the things that we've seen from the Fed, not just from Jay Powell, but from other Fed speakers, is that over the course of recent months, really, the bar for hiking rates really has been raised quite significantly. But actually, the bar to clear to cut rates has probably become a little bit easier. So I think he's probably going to sound off a little bit more dovish, but re-emphasise the points that you sort of made at the top there, that we've got to wait and see how this coronavirus hits Chinese economy and then the global economy and ultimately, obviously, the US economy. But I think at the moment the Fed does stand ready to cut again. Certainly, if I was sitting here at the end of December, very beginning of January, I'd have said I think the Fed sits on its hands all the way through this year and there's no cuts, and central banks are kind of going to be a little bit boring. But obviously that pricing is now changing, and I think we have got to now consider the idea that we do get another cut from the Fed. Maybe around June time, maybe, but certainly in the second half, unless there is a rampant pickup in the economy, which looks a little bit uncertain at the moment. So I think definitely easy monetary policy from the Fed, easy monetary policy from all central banks in 2020 is definitely the order of the day.
If you take the view that the coronavirus outbreak is occurring against a backdrop of what is mostly a healthy US economy, and the jobs number on Friday probably supports that view, and you do expect potentially one cut from the Fed in 2020, does that mean that you would prefer to allocate to US equities over the rest of the world?
It does. I mean, there's a lot of reasons why I still prefer for US equities over the rest of the world. And a lot of it actually goes back to also the tech cycle as well. One of the themes that we were talking about before the Middle East things started to kick off and before the coronavirus was this nascent pickup in the tech cycle and the coming online of 5G as well. Well, all of that sort of gears into a lot of the tech companies, and where are the biggest tech companies? It's in the US. These are the companies that have the best earnings, the best growth backdrop as well. So I think if you're getting lower rates, it just pushes you more into growth, less into value, and that puts you into US equities. So the US is still the best place for us to be. We still like emerging markets actually as well. And again, obviously that's been very painful during the month of January, but we think with that pickup in the tech cycle, that can be very good for emerging markets. And if you get further easing in policy as well, that's another sort of tick in that box, we would argue.